This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, August the 10th, 2016. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers' report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term confidence and sentiment. This month I'd like to cover a range of linked topics listed here. I'd like to talk about how policymakers have changed the function of the financial markets from price discovery and capital allocation to a promotional platform for the maintenance of national confidence. First, however, I'd like to discuss the current affairs from an economic and markets perspective. Global trade has slowed significantly. This chart, which you have seen in previous reports, shows total global exports and the degree it has slowed down into 2015 compared to the 2008 financial crisis and the post-dot-com bubble implosion. What it doesn't show is the breakdown of the advanced economies versus the emerging nations. This chart of the export volume index illustrates that the developed economies are barely back to 2008 levels after trillions of dollars of stimulus, while the emerging economies, which benefited from it, have now peaked and are falling off since the U.S. Quantitative Easing 3 program was terminated with taper. When we look at both exports and imports, we can see a steady deterioration in the year-over-year percentage change since the post-financial crisis highs, with both rates now actually contracting. Global trade volumes are now falling. As we laid out in this month's special focus in the Global Macro Tipping Point report on the U.S. economy, it is nearing recession levels or possibly is already in one, which we won't find out for another couple quarters. This chart from Elliott Wave International shows the 10-year growth rate of real per capita GDP. It has been on a downward trajectory for a few decades now, but the last decade has been particularly troubling, giving the impression that a secular structural change in the U.S. economy is significantly taking a toll. I would argue that since 2000, this is primarily about basically the deindustrialization of America, as well over 50,000 manufacturing facilities have left the U.S. since China entered the World Trade Organization, or WTO. Jobs and consumers in a 70% consumption economy are feeling the disposable income pains associated with this change. There is little doubt about that, but for some reason the media does not want to talk about it. It would appear that total U.S. business sales are getting much harder to come by. Previously, even smaller slowing than this has resulted in U.S. recessions, as shown by the shaded gray bands. The year-over-year rate of change has gone negative, as we have witnessed 6 consecutive quarters of top-line growth deterioration in the S&P 500 and 5 quarters in terms of earnings. What is more troubling to me is that the rate of change of U.S. corporate investment has fallen below zero. It is not only not growing, but in fact borders on absolute contraction. These facts cannot be lost on policymakers and central banks charged with steering the U.S. economy. It is evident to anybody who cares to look. monthly numbers, such as the change in U.S. factory orders, is watched by everyone. It continues to deteriorate badly and has all the earmarks of signaling a U.S. recession. Are policy leaders asleep at the switch? I actually don't think so, and in a moment I'll show you they definitely are not, in fact. First, however, I need to show you how alarming the numbers have become if this isn't already troubling to you. We see here nominal U.S. GDP growth with and without consumption, as I mentioned earlier. In a 70% consumption economy, this is frightening to policymakers, especially considering the secular structural changes we mentioned previously, and on how high-paying U.S. jobs are being replaced in aggregate with much lower-paying jobs. Assuming, that is, that you can find a job and you haven't dropped out of the labor force or are part of the non-participation rate that's continuing to grow in the United States. The Fed's GDP Now forecast has plummeted, as has the recent GDP numbers. What is really a mystery is why the macro numbers published by the government have all of a sudden shot up at exactly the same time as the GDP numbers are going south. It shouldn't work this way, unless the macro surprise numbers are being orchestrated. Meanwhile, the S&P is reaching for new highs, as even the U.S. Treasury yield curve is screaming problems ahead. Why would this be? What does the equity market see that no one else sees? Or is something altogether different going on that is causing this ongoing and pronounced divergence? I want to leave this part of our discussion momentarily, but before I do, I consider this chart of our U.S. factory orders. We can see that when QE3 ended, U.S. factory orders steadily fell. This corresponds to slowing global trade falling with the termination of QE3. We saw energy markets collapse from north of $110 a barrel down into the 30 range, now back to 48. We saw commodity prices around the world completely collapse. And additionally, we saw at this period of time China go into a major slowdown, which is looking like a hard landing. But also look at the S&P 500. It topped and appeared to be heading lower until Q1 this year. We all remember the violent market sell-off at year beginning 2016. Something, however, happened in Q1, specifically the end of January and first part of February, and suddenly the markets once again continued to rise. What happened? This is what we really actually need to understand and what we need to zero down into. As I said, I want to leave this discussion briefly before we answer that question specifically. Our policymakers and monetary mavens are no doubt concerned about what is happening in the credit market also. I've been talking for some time that I feel the credit cycle has turned and the evidence is becoming insurmountable. Debt to EBITDA ratios of the S&P 500 ex financials of corporations are now at the highest point of this century. This is alarming as non-performing loans are climbing as bond ratings are steadily deteriorating. This is forcing credit lenders to pull in their horns and tighten lending standards. This is exactly what a slowing economy does not want to see happen. A potential recession could quickly become much deeper, more pronounced, and more protracted than expected, dramatically so. Clearly, action is required and has been required for some time now. If you had been following the economic numbers and not simply the nightly news cheerleading about rising markets and keeping viewers and the advertisers happy and frankly sedated. When policymakers see charts like this, where corporate profits with inventory valuation adjustment and capital consumption adjustment factored in, they panic. Anything comparable has resulted in a major market drawdown. A drawdown today that, due to the degree of financial leverage being employed and additionally the abuse of rehypothecation in the debt market, could lead to a market crash of historic proportions. It must be averted at all costs. It is job one of the Federal Reserve, that is, to deliver market stability. This chart, which I have shown in previous reports, illustrates that the two global engines of the world, China and America, can no longer support a sufficiently high enough sustainable rate of credit expansion. This insufficient rate of credit expansion is resulting in shrinking imports, which has powered the rest of the world. The timing for the central banks to react has also not been a surprise when you consider the Economic Output Composite Index. Q1 2016 was the time. We're back to this first part of February timeframe. We also showed this chart previously, which further said central bank action was required because, like life support, the host body could no longer survive without it. The global economy has crossed the Rubicon to where few options other than increasing the money supply really truly exist. Though it got little real fanfare, the central banks did in fact begin reacting in Q1 2013. That data has not been available to us until just recently. Specifically, the ECB and Bank of Japan in a massive way, we were aware of that, but the degree to which is now becoming clear. Their combined reaction was double the size of QE3 at approximately 180 billion a month of liquidity injection. With the Bank of England's announcement of quantitative easing on Thursday, that is last Thursday of August 4th, this takes the total to over $200 billion a month. We're approaching triple quantitative easing 3 without the US's participation. Yet, never in the history of monetary policy so we ever contemplated, ever mind done, such a set of actions. Is it any wonder markets have stayed elevated? What is amazing is they should be going parabolic, exponential, with this amount of money flowing into the system. This, in fact, is Bernanke's enrich thy neighbor doctrine that he talked about in full bloom, whereby if all players debase their currencies in a coordinated manner, they can all win, but only if it is coordinated. And it's basically a ring around the rosy as they take their turns. And it looks like the US is next up. When we examine the world markets in total, and that is the world markets in total, using Morgan Stanley's CI World Stocks Index, you can see clearly the effect this has had since early February. The central bankers did in fact react. They did their part. At what ultimate cost? Only time will tell. But let's ensure we don't forget that there is also fiscal stimulus, specifically government spending. The U.S. may have reduced its fiscal budget deficit, but not actually in comparison to the reduction we're seeing in GDP. In actual fact, total public debt to GDP has been steadily increasing. Debt which is being used to prop up an entitlement program which is somewhat sustaining consumption, at least the best it can. In case you think this is only a U.S. problem, think again. This is a global problem with few ways out and few real answers other than more liquidity. The problem is the market is becoming very concerned about central bank policy initiatives as the market divergences increasingly become significant from any normal historic measures. Growing uncertainty is placing more pressures on the central bank's liquidity injections as fewer investors are participating and increasingly so see the risk reward no longer there. Smart and professional investors look at charts like this of enterprise value to EBITDA, that is cash flow, in the Russell and exit. And exiting they are. For a couple months now, I have been highlighting this Bank of America Merrill Lynch tracking of their client base. Year-to-date flows from their hedge funds and institutions is negative, as well as their private clients. These flows have been steadily there since the beginning of the extend and pretend rally began after the financial crisis, when the central banks suspended price to market and began their great monetary experiment of ZIRP and quantitative easing in all its ever more convoluted forms. I was not shocked when I found out recently that in addition to this kind of liquidity pumping that's been going on, that the Swiss National Bank was in fact buying stocks on the U.S. stock exchange. They have now accumulated over $60 billion in U.S. equities. We have known for some time now that the Bank of Japan has been buying the Nikkei and presently owns 40 to 60% of all ETFs traded on the Nikkei. But other than the Norwegian Sovereign Wealth Fund, nothing of this size was at least evident. What I did find particularly interesting was which stocks the Swiss National Bank was targeting. The answer is those stocks with the biggest leverage in elevated U.S. equity markets, what they refer to as the Fab 5, highlighted here in red. They're clearly trying to drive up the market value as really picking any specific stocks. They're trying to drive up indexes. The question, however, should be, and the one we should be asking, is in fact whether the Swiss National Bank is buying these stocks, or is it just part of a private swaps arrangement with the U.S. Federal Reserve or U.S. Treasury? I suppose we won't ever know for sure, but proves the markets are no longer standing on their own strength if this is the case. We do see that they are artificially being propped up here. The global market, as measured by the global Dow, has come to a cusp. It is at a point where it either fails and tries to find support at lower levels, or it breaks out dramatically to the upside, one or the other. This is the situation that I sense the central bankers are acutely aware of. Is it any wonder that the Bank of England unloaded quantitative easing and corporate bond buying last Thursday? I don't think so. This is what they see. They have got to keep asset values, both stocks and equities, elevated. The LONGWave practitioners see the same thing in a much more dramatic fashion. Some see the recent highs as the end, in fact, of a multi-decade rise at large degrees of count. Minimally, we can conclude the central bankers and their cadre of technicians are watching this closely to see how all the technical-driven algos will react to it. This is the cusp, and we're at it. And that's why the money printing and liquidity injections are coming in at such a rate, and I suspect will further accelerate. Even our long-term MTOP is saying the same. Either we fail or extend in a mirrored fractal of the pattern we have been seeing since 2000, which has the last big leg shown in the starting at the end of the 2008 financial crisis, extending in the small fractal shown up in the top right-hand corner. How this dilemma may be answered and what is going to happen is by considering the following hypothesis, in my opinion. First, we have everyone warning about the excesses in the market. When the sell side of the market starts warning, which I don't ever recall seeing, it is truly an unusual situation. Secondly, we have the smartest investors in the world screaming at the top of their lungs to get out. They are also betting huge amounts on an approaching negative outcome. We've even seen George Soros come out of retirement because he is so concerned about the markets, or maybe bluntly see such an opportunity to short the markets. How could so many smart people be wrong then? I mean, clearly this is what is going to happen. But just maybe what they are missing is the possibility that the market is no longer a market, at least as we have traditionally understood the term to mean. The fact is that since a large concentration of total asset value is so dependent on the market, it has now become necessary to maintain the market at all costs. The market has become too systemically important to allow it to possibly fail. The market is too big to fail, not the banks. The policy makers, either knowingly or unknowingly, have changed the function of the market. It has become a false portrayal of the underlying economy. That's how it's perceived on the nightly news. What we now may have is a market being used as a political and economic controller of public sentiment and confidence. It must be held up at all costs or the whole system implodes. Like a Ponzi scheme that depends on a continuous stream of new money to fund the myth, we have a situation where the public narrative must be more and more convincing to maintain the mistaken beliefs in the market despite obvious proof to the contrary. Once the control of the public narrative breaks down, though, and it will happen, the whole con becomes exposed. The question is, what will break down in the narrative? Time will tell. Could it be the fact that Trump might win the election? We could speculate, but there is something that will end this narrative. Simply said, a correction from these levels can never be allowed. Withdrawal will kill the attic here. We have seen it before on the previous collapses, but it's always been somewhat manageable to this degree. And with U.S. productivity falling, and as Alan Greenspan warned earlier this year about the seriousness of this, it's becoming a monumental problem. What this means is we have likely entered the initial stages of the Minsky moment that I've been writing about for some time. Continually larger doses of liquidity will be brought to bear with even more elaborate explanations, though we will be told the economy, markets, and recovery are all in extremely great shape. Watch their actions, not what they say. They're saying things are fine, then why are they printing $200 billion a month and growing? Their actions suggest we are in the midst of a historic crisis, and I don't use that word lightly, that the history books will write about for centuries. It's occurring. They're just not talking about it on the nightly news. But in the end, don't worry. They will print the money until the money is no longer of value and nobody will take it, and we have a currency crisis. I would like to take a moment as a reminder. Do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2016 be an outstanding investment year for you and your family. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.